Mark, thank you for joining. You know, you have this environment where a lot of people are expecting an interest rate cut this year, but it's only at least one expected. You still have higher interest rates to contend with. What does that mean?
Well, for private credit, it's actually good news because with the higher reference rate, we're still yielding around 10% on our unitranche investments. And so if you look versus several years ago, if you're getting, let's say, 500 or inside that now, you're still at 10% on basically a first lien. And years ago, we were, in free money environment, we were getting 700 basis points of zero. And so 7% for second lien versus 10 for first, I think the latter is better.
So how low do rates need to go to start to change the calculus for the private credit industry?
Well, so this is sort of everybody worried about the credit aspect of higher rates. And the risk was that they kept rising. So if the reference rate went from 5 to 7, that would have been a problem probably as you look at free cash flow coverage. But the challenge would be if things spike down quickly, your yields would collapse. So we actually we like higher for longer.
Do you worry that that's a reality if the economy were to turn meaningfully?
In terms of inflation or in terms of...
If the economy slows and the Fed needs to cut faster.
Well, so that's probably a bigger risk, right? Because then if the economy really, we've had growth this whole time in our companies really, really nicely. And if you had a turn down in that would affect credit, and that would be a challenge. And you'd probably have a double whammy, right? Where you'd have lower yields and worse credit.
How much are you worried about that being a reality at this point in time, just given how strong things have been, to your point?
We like the stability. And, I was asked, I was at a lunch in Toronto yesterday, and I was asked, what's the outcome of the election? For private credit, at least for what we do at Crescent, I think either way it's fine because rates are going to be stable to down slightly. Obviously, if Trump wins, it might be good for the energy industry. We don't invest in energy in our private portfolio because we think you need an expertise that we don't have. So I think we're well positioned either way, and so that's and I think the industry generally, there's so much more dry powder in private equity than there is in private credit right now, direct lending, that the supply-demand characteristics are very favorable for us.
You brought up the election. Really curious on how you're thinking about it. Do you have a sense on whether Trump or Biden is better for the bond market?
I'll leave that to the bond geniuses. It's hard to say. I think there's general feeling that Trump might be better, but I don't know about that.
Is there any reason why you think?
Just that more favorable for the business environment, but that's really a macro view, Democrat versus Republican. I think President Biden, the economy's done pretty well under President Biden, and probably doesn't take enough credit for that.
So if you look at where people are trading right now, how spreads have gone, you have this exuberance in credit markets today. Do you think that people are entering credit markets ignoring the risks out there?
No, I think they're mindful of them, and the public markets versus the private markets are different concern. But we have historically, we can look over 30 years in our portfolios, so you can see your own cooking, so to speak. We have the best, as favorable a loan to value as we've ever had, is still inside 40% loan to value. We have significant free cash flow coverage. Yesterday we approved a SaaS investment in the medical industry, and it had 1.5 times free cash flow coverage, which for us now, the fact they kept talking about how tight it was, because some payments were being made to executives in transition. And in the old days, if you had true free cash flow coverage, a lot of times it was 1.2. So we were getting a little concerned that we were at 1.5. We tend to be high ones in free cash flow coverage. It's very, very favorable.
The other thing you're here to talk about today, and a lot of investment interest in sports leagues, Mark. And of course, you've been known for your role with the Brewers, but also your view into the golf M&A world right now. What are you most excited about?
Well, actually, if you're stepping back, we like to look for change. So everything, and we'll talk about with Tom Werner, who really, the Fenway Sports led this investment in the PGA, but everything that made that a complex investment is what created the opportunity. The change in college sports now is going to create enormous opportunities for investment, and that we can't even define yet. So, stepping back, looking forward over the next couple of years, that's one of the places we're going to look to gain opportunity. Otherwise, right now there's nothing like a live sporting event. So we're looking at everything from women's volleyball to professional sailing. Larry Ellison is setting up a league to kind of replicate what happened in F1, as well as the major sports. We are co-majority owners now in the Norwich City Football Club in UK. They call it football. You do use your feet. Still have to be careful. In the UK, call it football. Here, you got to say soccer. And so there's a lot of, as a global sport, that's incredibly engaging. I found myself, I couldn't believe I turned off a Sunday night baseball to watch Panama play because we just signed one of their center backs. And I didn't even know what a center back was 2 years ago.
So the college sports idea is pretty fascinating. You've seen some teams reportedly, or some private equity firms rather, reportedly be looking to spend large dollars, $1 billion, $2 billion into, say, the Big 12. How do you think about an entry point here, and how much money would you really be willing to put forward into the college sports opportunity?
Well, you have to recognize it's a changing landscape, and there's not a lot of structure to it right now. I actually have a small investment in the Big 12, in a piece of it, and these leagues were not, or these conferences were not set up to manage this kind of capital.
But what's the opportunity then, and how fast can it come?
I think it's going to, like I said, we've already made one small investment in a seed small thing to help market and organize their commercial opportunities. So I think it's going to come very fast, but as to what it'll be, we'll see, right?